You can follow all the right money rules and still feel like you are never getting ahead. You can save more, invest early, work hard, and still feel like that financial scoreboard never moves. Earning more money just isn't enough, and in this video, I am going to show you exactly why. I am Wesley, and welcome to Wesley Wealth. I have spent years studying how the absolute wealthiest people operate, and I realized something profound. Money does not follow rules, it actually follows laws. Today, I am going to break down the 7 hidden laws of money that the ultra-wealthy use to multiply their net worth. And I'll give you the exact frameworks you need to apply them to your own life. Let's start with law number 1. Money loves speed, but wealth loves time. Most people completely confuse fast action with fast results. Speed is simply the shortest distance between seeing an opportunity and taking action on it. Time, on the other hand, is about making a good decision and allowing it the runway to actually compound. Let me give you an example from real estate. You might have one investor who acts as a flipper, buying a house, rehabbing it, selling it quickly for cash, and repeating that process 100 times over 5 years. But then you have another investor who buys one single-family property, waits, buys a 4-unit building, waits, pulls some equity out, and buys a 20-unit complex without ever selling. At the end of those 5 years, the flipper has cash from speed, but the investor who held the properties has a net worth 5 times higher because they used time as their business partner. Warren Buffett proved this with Berkshire Hathaway by buying high-quality companies and holding them forever, eventually hitting a 5,000,000% total return. To master time, you need a framework called the Rule of 3 Decades. Decade 1 is building a war chest, which means you earn more and spend less. Decade 2 is letting it compound, meaning you do not touch your investments. Decade 3 is living off 4% of your wealth. When you respect time, compounding does the heavy lifting for you. This brings us to law number 2. He who gives the money has the power. If you look at the Forbes 400 list of the wealthiest people, 0 people made it onto that list strictly through their earned income or a salary. The vast majority are buyers and builders. Elon Musk bought Twitter. Buyers unlock value others can't see. Google bought YouTube, and Facebook bought Instagram. Same pattern, different platforms. Massive wealth is created by buying and building, because the buyers are the ones who unlock the value and control the terms of the deal. Even in sports franchises, look at Mark Cuban, who bought the Dallas Mavericks for $285 million. He eventually sold a majority stake, valuing the team at $3.5 billion. Even if you don't have billions in cash today, adopting this obsession with buying and building assets will create massive momentum for you, because whenever there are no buyers, there is no market. Law number 3 is that leverage multiplies everything. Entire trillion-dollar industries, like private equity and commercial real estate, exist entirely because of leverage. Let's say you buy a $1 million house with all cash and it goes up 10%. You made a 10% return. But if you buy that same house by putting down $200,000 and using an $800,000 bank loan, that same 10% appreciation gives you a 50% return on your cash. Leverage completely magnifies your returns. Billionaires use this constantly. Instead of selling their stock and paying massive taxes, they borrow against it to buy new assets, using their stock as collateral. Leverage is the ultimate economic growth engine, and because borrowed money isn't classified as income, it comes with massive tax advantages. Law number 4, cash flow keeps you alive, but equity makes you free. Cash flow is the money you need today. It funds your current lifestyle, pays your mortgage, and covers your vacations. But equity is the wealth you create for tomorrow. Think about McDonald's selling burgers and fries makes them a lot of cash. But their real wealth comes from the $45 billion they hold in real estate. To become dangerously wealthy, you must own equity, whether that means owning your own business or using your cash flow to buy a piece of someone else's publicly traded company. You do not even need a massive income to do this. Consider the true story of Ronald Reed, a janitor from Vermont who drove a used car and clipped coupons. When he died, his estate was worth $8 million because he simply bought shares of blue-chip American companies and never sold them. Real wealth is just the gap between your income and your ego, multiplied by time. Law number 5, risk and reward are non-linear. We are traditionally taught that risk and reward are a 1-to-1 ratio, but the wealthiest people operate like venture capitalists. A venture capital firm might make 5 investments of $100,000 each. 2 might go to zero, and 1 might just break even. 1 might go 10 times their money, and the last one might return 100 times their money. They make calculated investments where their downside risk is strictly capped, but their potential upside is massive. The goal isn't just to bet everything to win big once. The goal is to systematically cap your downside so you never lose the game, while always swinging for that asymmetric upside. Law number 6 builds right off of that. Do not bet the empire for a pot of gold. This law is all about sizing your bets. I know of a couple who systematically saved over $700,000 over 15 years. They lost every single penny by putting their entire life savings into one single, risky oil and gas deal. You cannot risk the machine that produces your opportunities. The legendary investor Ray Dalio teaches that your job is not to chase higher returns by blindly taking on more risk. Your actual job is to figure out how to reduce your risk while keeping your return exactly the same. To do this, you need a system to filter out bad investments. First, run any deal through the 4 goods framework. You need good people, good intentions, good rationale on the spreadsheet, and finally good contracts. If any of those 4 are missing, you walk away. Next, you run it through the investment X-ray, which scores an opportunity across 4 categories: capital preservation, tax efficiency, cash flow, and growth potential. Using these frameworks ensures you meticulously size your bets and protect your empire. Finally, law number 7, diversification is a hedge against ignorance. Wall Street constantly tells you to spread your money across everything, but the truly wealthy do the exact opposite. Evaluating an investment comes down to 2 vectors: risk and control. When you do not understand an investment and you do not have control over it, you are really just hoping it works out, and that is when you should completely diversify. But if you deeply understand the risk and have control, you should concentrate your bets. This is why founders like Jeff Bezos, Elon Musk, and Mark Zuckerberg keep their wealth heavily concentrated in their own companies. They have insider information and understand the risks deeply. And they have the future control to guide the business. Now you know the 7 laws that decide whether your money aggressively compounds or completely disappears. Knowing the laws is just the first step, but putting the frameworks into action and letting time do the work is what will actually set you free. If you got value out of this video, hit that like button and subscribe to Wesley Wealth. Drop a comment below telling me which of these 7 laws completely changed your perspective on money. I will see you in the next one.